There are millions of people, and yes, probably including you, that own an S&P 500 index fund. It could be VFV, XUS, ZSP. If you're here in Canada, those are very popular funds. Maybe it is SPY, VOO, or IVV if you're investing in the US. If you have an RSP, a 401k, a pension plan, a TFSA, or even just a broadly diversified ETF portfolio, there's a very good chance that you already own one of these funds. But here's a question that almost never comes up. Which S&P 500 do you actually own? Most people assume that there is only one version. Now, in this video, I'm going to compare two different versions. First off, the traditional S&P 500, the version that's tracked by ETFs like SPY, VOO, IVV, VFV, ZSP. This is a market cap weighted fund. That means that the largest companies in the fund, they have the biggest impact on the returns. Now, the second one, though, is the S&P 500 Equal Weight Index. This is most commonly tracked by the ETF RSP. In this index, every company starts with the same allocation regardless of its size. Now, most importantly here, this second version has been a very useful way to understand what's happening beneath the surface of the market. So when I look at these two versions here of the S&P 500, which have behaved through expansions, recessions, recoveries, and now in today's market, we can learn a lot about things like market breadth, market concentration, and I would suggest why investors should actually pay attention to both of these. I'm going to look at 7 specific time periods, and I think that you're going to be surprised at how different these identical funds can actually perform. Now, I want to start with the time period 2003 to 2007. This is expansion with widespread participation. So when we look back at the time period following the dot-com recession, the 2003 recovery gained traction very quickly. Monetary policy was very accommodative. Credit was expanding. Housing activity accelerated. Things like industrial production improved. Commodity strengthened. Financial stocks all rallied. So which of the S&P 500 funds do you think did a better job during that expansionary period? In that 2003 to 2007 period, RSP, so this is the equal weighted fund, outperformed the SPX and by a huge margin. The equal weight basically doubled from the lows and easily pulled ahead of the cap weighted index. Now, I forgot to mention earlier in the video that around 97 to 98% of the assets in this type of fund, in S&P 500 funds, are in the market cap weighted products. So what does this tell us? First of all, during times like this, we see a very broad participation in the markets. We see a large share of companies contributed to the index gains. Financials, industrials, materials, mid-sized firms, they carried a real weight in performance. We also saw that strong economic growth would translate into widespread earnings growth, and periods like this often align with early and mid-cycle expansions. We see things like increase in risk appetite, investors extend further into cyclical sectors, performance disperses across the index rather than clustering in a few of the mega cap names. Now, I do want to look at the next time period. This is as the cycle matured, 2006, early into 2007, and the relative performance gap began to compress. You'll see that here. In this time frame, the RSP ETF still outperformed, but SPX did show more resilience during certain pullbacks. Now, this is a late cycle phase. We know that by looking back through history, and that often brings a shift towards more larger, more stable balance sheets as investors become selective. Now, the change here is often gradual, but the character of leadership, that's what we really see involved here. Then the system just breaks. I want to move ahead to that breakage in 2007. This is the credit contraction time frame. The financial crisis represented a fundamentally different type of environment. We saw things like liquidity evaporate, credit spreads widened, earnings basically collapsed across various sectors. In this chart, 2007 to 2009, both SPX and RSP took a big hit. RSP fell a bit further, and that does reflect its greater exposure to economically sensitive and mid-sized firms. Companies that rely heavily on external financing or cyclical demand, they do tend to experience deeper drawdowns during credit crisis. Now, SPX, this fund had the heavier exposure to the large multinational firms, more defensive balance sheets. It held up marginally better in relative terms. The difference there, not huge, not dramatic, but it does reinforce a very important point here that index construction influences how stress is absorbed. We also learned here that broad participation during expansion doesn't insulate a portfolio from systemic contraction, right? When the financial conditions tighten rapidly, the higher beta exposure is going to amplify volatility. Now, if you don't know what beta is, I will put a link here to tell you about a video that covers that topic. Now, let's move now to 2009, 2011 time period, the early cycle rotation. And the rebound in the markets that began in March of 2009, it kind of reverses many of the relationships that we just covered off here. In this chart, RSP regains leadership and it outperforms SPX through 2010 and into 2011. The key takeaways from this chart are that early recoveries will often reward cyclicals and sectors that were previously distressed. As we see confidence return, capital is going to flow back into smaller mid-sized firms with greater operating leverage. We're going to see things like financials will stabilize, industrials probably rebound, and risk appetite tends to broaden. And if we take all of this into aggregate, the patterns that we see from 2003 all the way to 2011, they form a very recognizable sequence. We see expansion with broad participation, late cycle, we see selective leadership, crisis, defensive resilience comes into play there, and then recovery, we see that renewed breadth. And SPX versus RSP sort of becomes a lens for viewing where the market sits within that progression. Now, I do want to move to cover the more current charts. So we've got sort of a historical framework in mind here, but let's look at 4 more recent charts, starting 2021 to 2026. This is where we see extended mega cap dominance. When we look at this chart here, it shows the SPX regains the lead and outperforms the RSP by a huge margin. Now, over that stretch, we see cap-weighted returns a lot stronger. And this might also explain why so much more money is flowing into that type of fund right now versus those equal weight funds. Remember that 97, 98% of money is in the market weighted or the cap weighted funds rather than in the equal weighted. This time period we're looking at, it also includes the post-pandemic fiscal stimulus, a rapid technological adaptation, the resurgence of large platform companies. Few things to consider here. Earnings strength in these mega cap technology firms right now has played an outsized role in the index performance. When a small group of companies, they command such a large share of the market capitalization, and when they deliver strong earnings like we've seen here, then the cap-weighted indices will naturally magnify that type of impact. Now, phases like this don't inherently signal instability. You could imply that by looking at the earlier data, but it doesn't necessarily say that, but it does imply that the overall index performance depends more on a heavily concentrated set of companies. Now, if we look at 2023 to 2026, we see that narrow leadership that becomes so much more apparent. This chart shows the divergence as obvious here. The SPX advances a lot more while RSP trails by a wide margin. And so this would suggest that the gains over the period have been unevenly distributed, right? We've got the market cap rate versus the equal weight. So the largest constituents disproportionately contributed to the returns. Historically, as we saw a bit earlier, when we see extended periods of concentration, that can emerge in a late cycle environment or during structural growth phases. And it does matter, that distinction there, because if earnings growth remains durable, then this concentration can hang in there for a lot of years. But if macro conditions are shifting or if the valuations compress, then the same concentration can definitely lead to underperformance. A couple more charts here. This past year, the performance gap narrows considerably. SPX, RSP, they post quite similar returns. When equal weight keeps pace with the cap-weighted index, it often indicates we're seeing improving internal participation. Things like more sectors are contributing to the gains. We're seeing that these days. The distribution of returns becomes less skewed towards just the larger names. Now, short-term convergence doesn't confirm we're seeing a shift here, but it does suggest at least that leadership may be broadening compared with the multi-year stretch that we saw leading up to the current times. Now, let's look at year-to-date. So quite focused in here, 2026, we're seeing early signs of rotation. This year-to-date chart presents an even more interesting development. RSP outperforms SPX over this short period. Now, in practical terms, this just means that the average stock has outperformed the largest stocks during this time period. It's a short window, but it can reflect things like temporary rotations. It can reflect positioning adjustments or sector-specific catalysts. And when we do see sustained equal weight leadership over longer horizons, that has historically aligned with expanding breadth, improving risk appetite. Now, whether what we're seeing now marks the beginning of a durable or a lasting rotation, or whether it's just a brief adjustment, we don't know yet. But this structural shift that we're seeing now only becomes important if it sticks around for a while. So a few final thoughts here. Both SPX and RSP, they own exact same companies. Their divergence, though, is in weighting, right? Not actually in composition. If you look across the full cycles, we see the differences revealed in the patterns, things like market leadership, economic sensitivity, investor risk appetite. So my suggestion is, rather than focusing just on whether the index is going up, it's probably more informative to examine how those gains are actually distributed. I hope this showed you something that you either didn't already know or maybe hadn't thought of recently. Don't forget to subscribe, like the video, forward it to someone you think would enjoy. As always, thank you for watching, and we'll see you in the next video.